Good morning, good afternoon, everyone. My name is Ross, and today is a very special video because this is the beginning of the educational series where I'm gonna cover the most important theoretical concepts and their implications to the financial markets. And today, guys, I'd love to start with AMT or auction market theory. Let's go. Although there is no lack of information around various indicators, oscillators, MACD, RSI, overbought, oversold, unfortunately, and that's what I encounter, 95 or more, 99 sometimes percent of traders have a very, very poor understanding of why do markets actually move. And without this fundamental knowledge, it's impossible to progress on your autonomous decision-making journey in trading. So today, I would love to elaborate on a very fundamental concept, which is called auction market theory. And thanks to the understanding of a very basic theory, I promise, guys, I'm gonna try to do it within 10 minutes. Nothing really overcomplicated, but this is a fundamental way for you to progress and to understand how other concepts can be built up on top of that. Let's go. The origin of the theory goes back into 1980s when Peter Steidelmeier developed the concept of auction market theory, and Jim Dalton was one of the first to actually recognize the value behind his ideas and contributed to them in a practical form in his famous books, Mind Over Markets. Basically, auction market theory breaks down the market's primary purpose on how market participants interact. And there are two major ideas behind, two major things that market participants want to achieve. They want to facilitate the trade in the two-way auction process, and they want to do it at the fair value. They need to define the fair value of the asset. The main idea lies in the fact that financial markets are anyhow different from any other auctions, where buyers and sellers meet daily. So it provides one perspective of how financial markets operate. It considers market as a continuous interaction between buyers and sellers with their particular pressure that determines price movement. And when applied to financial markets, we consider that every bid is an attempt to buy and every offer or every ask is an attempt to sell. And what is fair value? Well, fair value is something which is driving the balanced market. In a balanced market, buyers and sellers agree on prices and they're willing to buy and sell for this particular price or slightly around it. And it's because they perceive those prices as fair. So a balanced market is usually represented by low volatility and higher volume. So prices remain more or less the same and markets are ranging. And many times we spoke about those in my educational videos when we spoke that actually the nature of the market is ranging, and 80% of the market is of the ranging nature, not trending. So fair value looks like so-called Gaussian bell-shaped curve. And this bell-shaped curve is giving us an understanding that most of the volume, or 68.2% deviation of the price, are transacted around our fair value. And this is the strategy that is very often also used by institutions, so-called mean reversion strategy, when we definitely can see if price runs too far here, that will be a bid and the price would come back, and vice versa when price is running too far here, unless it starts to accept in this range, and then we start to formulate new fair value. But we're gonna speak about those in a second. And this is exactly how auction market theory is helping us to understand that fair value or efficient market is the normal condition of the market, where market is being for normally 70, sometimes 80% of the time. Sometimes time is not the best way to represent that because a market can be there for actually longer, but 70 or 80% of the volume would be transacted. at this range. Actually, volume is something extremely important, and later on, when we're going to start applying auction market theory into the markets, I would explain why, how we can use volume and not time in the market to understand where our price is gonna go. So when demand is more higher or more aggressive than supply, or vice versa, when supply is more aggressive than demand, what happens? We are formulating an imbalance or inefficiency. Let's have a look on this example. We had a range. Let's maybe, for an example, take a particular stock and think what can happen. Let's say we had Apple stock. We recently were shorting for those in my Telegram group. You remember when that was happening. And we kind of had a top distribution, so to say. And then we received the news that Berkshire Hathaway and Warren Buffett was bearish and sold a multi-billion stake in Apple. So obviously market reacted. We had a particular triggering event. The triggering event caused supply to effectively outpace the demand, and we start falling down. We start to accept into the new range. And this range was able to formulate its new fair value or fair price. And later on, let's assume Apple came up with a certain acquisition measures on the particular artificial intelligence company, and market positively reacted to that. So there was another impulse, another signal that moved market to a new balance, and this balance probably was even higher than the previous balance. So this is how the auction market theory would explain what is inefficiency, and that inefficiencies always need to be revisited. And how they are revisited? They're revisited through the price discovery. When the price is starting to look for balance or efficiency to come back to its normal state of a fair value, where it is being for 70 or 80% of the time. Looking at this chart, we can have a bit of a different type of view. So we're going to say that we have created first range number 1 and then range number 2, where the fair value has been set up. Right now, for simplicity, we're not going to project the volume profile into the charts because that's going to make our studies a little bit more complicated. I'll show you in a bit in our second video how to do that. And we're going to go on the intraday level. But right now, for simplicity's sake, let's just assume that the volume has been transacted somehow equally here. And our fair value was somewhat around the middle point of this range. Somewhat around this area. So we were able to range in that around this fair value for, let's say, our 1 sigma deviation for nearly since 6th of March until beginning of May, for 62 days. And then we have started to lose the area around our fair value, but the buyers were very aggressive and stepped in, bringing the price all the way first to the fair value and then to the upper range. That happened second time, and buyers were also able to protect us, but this time they couldn't bring the price all the way to the upper range around fair value, and we dropped down. The third time we retested the lower area of this range, but right now it looks like buyers are bringing us back into our previous range again. So we can consider all those 3 moments of the price as deviation, and we are right now accepting back into the range and are really likely to retest our fair value as soon as we close the day into this current range. And this is exactly why when you hear me talking very often, I was emphasizing the importance of the time that we stay outside of the range. Why? Because I don't want us to be in the previous range for 2 weeks or 3 weeks. I want us to quickly reclaim this range with volume, signifying the following. I want to be sure that, first of all, the price, which is provided as the advertised opportunity, has been met with the successful volume. Otherwise, I would consider is the failure of the auction. And this is very important, that price doesn't want to stay there for too long, because if price can be found at any moment of time, that is not attractive. It has to be limited as an offer. So buyers will step in anticipating that we're not going to see price at those ranges for longer from now onwards. When we're going to speak on a practical terms in our next video, you would understand what do I mean. We're going to scalp on the 30-minute time frame and see how auction market theory is helping us to understand intra-week and intraday behavior. Since I was trying to make the theoretical lecture short, please stay tuned, and at the end of the week I would provide you the particular practical trading strategy based on the auction market theory. Much love and stay tuned. Bye.